Okay.
Yeah, go ahead. Already. Let's go.
All right. So, good evening, good morning, good afternoon, depending on where everybody
Well,
is.
I
We
still
want to
don't
welcome
see
you
anything.
to,
Hold on a second.
yes,
Oh, now I
because
do.
there's a bit of
Okay.
a,
Okay.
yeah.
Deal.
Well, thank you for everybody who's patiently waited. Welcome to our first iFindTaxPro tax talk. Today's webinar, we're going to be talking about some latest tax updates and talking about how you can navigate them. And we also have Stan, who has just joined us, and he'll be talking about why 90% of businesses fail. And welcome, Stan. Welcome, Dmitry.
Yeah, nice. Yeah, thank you very much, Rox, for the introduction. It's great to be here today.
Right. So just to introduce myself, my name is Sikwane. I'm the VP of Platform Operations at iFindTaxPro. We are a software company based on the West Coast, and we focus on tax solutions for tax professionals and clients. And we've put together this tax talk webinar and platform just to bring together different thought leaders and to keep people who are keeping a keen eye on tax movement, tax updates, tax, as well as just educational content. So thank you for being here with us. Our special guest and expert is first Dmitry Kustov, CPA, MS Tax, and who's an iFind Tax Pro certified compliance professional with about 30 years of public accounting and tax experience. He's the founder of Kustov and Associates, which is based in San Francisco. It's a CPA firm, and he's an AICPA International Tax Committee member, as well as a published author. He has a startup tax guide, which is a must-read for founders and executives. And we're also joined by Stan Sukhinen, who has 18 plus years in investment banking and corporate lending at major global institutions. He's helped develop mezzanine loan products, shape Eastern Europe financial markets, and he's a former senior partner, managed over 450 million in loan portfolios and leading finance teams. He's a board member, alternative asset specialist, and the founder of Soso, which guides businesses to optimize cash flow and scale. He's also a CFA charter holder. And our agenda for the day is obviously the introduction, but we're first going to go into the tax talk with Dmitry just to go over some of the latest tax
Max,
updates,
um,
as well as, yes. So,
Max,
yes,
are
Dmitry,
you
go ahead.
sure? Yeah, yeah. Are you sure that we have, because it says 4 people waiting on, and I just received the email from a friend. Let me just see. Uh, well, he just, yeah, okay, okay. Can we make sure that we're being heard and seen? Because it says waiting. It doesn't say
We are
that they
live.
are.
We
No,
are
no, no, no,
Dmitry.
no. I understand we're live,
I'm
but
on
it says
YouTube.
is there, yeah, yeah, yeah. But what I'm asking, is there a um, special function to let people in? Is it public or is it private? It's public, right?
Yeah,
So I'm sure.
yes. So there we have some live viewers who are with us, and if you're live with us, maybe just add a hello just to
If
reassure
can,
Dimitri that
yeah,
you
would
are
be so
live.
wonderful, guys.
Yes.
Because it says waiting.
But Dimitri,
Max,
we're reassuring you that we do have live. So let's just continue, and people will join us as we're going. But you can refresh your feed,
now,
refresh your
hold on a
feed, and
second.
you'll see.
Now, hold it, hold it. Now, two watching. So that's good. You see, just now, 2 people watching. Okay, so perfect. Okay, hi, guys. Um,
Yeah,
Okay,
hi.
Dimitri. So I think we've done the introductions, Dimitri. Welcome, Dimitri.
okay,
Welcome, Stan.
Yeah, Rox,
Right,
thank you
all
very
and
much
right.
for the intro.
yes. So I think we're good to go, Dimitri. Right. So I think let's get into the business of the day, Dimitri. We're going to start with you, and you're obviously talking about some of our reports on some of the content that we've put out in the past 2 weeks. So and obviously this is leveraging from our podcast, which is available on Spotify as well as on YouTube. But without further ado, Dimitri, the floor is yours.
Awesome. Thank you so much, Rax. Excellent introduction. I just want to say a couple of words about our podcasts. They're daily. They represent various aspects of U.S. taxation in a clear and accessible way, and making them suitable for both the general public and those with a deeper interest in the subject. So we make it with the general public in mind. They're 10 to 20-minute episodes that cover select aspects of relevant tax rules and leaving room for future discussions. We in this podcast we take a deep dive into key issues, analyzing recent court rulings and IRS regulations to keep listeners informed. I think that whether you're CFO or CEO, tax professional, or an everyday taxpayer looking to stay updated, our content offers valuable insights. During our live webinars, like today, we provide a brief overview of the materials in those podcasts, answer questions, and take suggestions for future topics. So here we're going to present to you the last batch, the initial. I should put initial batch of episodes dedicated to various tax topics. It's an inaugural batch, and topics are extremely interesting. Extremely interesting. First one is related to crypto rules. So crypto is the most, I think it's the most dynamic area of the business right now, right at this moment. Perhaps AI and crypto, they compete with each other. And this year promises to be quite productive in that realm. Hence the selection of our inaugural podcast. President Trump has an ambitious agenda for the tax reform, and taxation of digital assets is one of the hot topics right now. And some of the floating proposals are mentioned in the podcasts. For example, make US issued crypto non-taxable and make foreign crypto taxable at 30%, something like that. So we'll see what's going to happen. We don't know. But the podcast, for the most part, of course, it covers basic rules that exist right now in crypto taxation. And here they are. Here they are. So as we know, the gain and loss is realized and is taxable or deductible when the digital asset or crypto is sold for currency. Currency meaning is it for currency here is US dollar or any other foreign currency. Or when it's exchanged for another asset. And cryptocurrency is just, for now, is still treated as an asset for right now. I believe for taxation, we're still in the area of an asset treatment. So therefore, when crypto is exchanged for another crypto, you have what we call a realization event. And because of this realization event, you have either income, gain, or you have loss, depending on what the value of the purchase and at the exchange time. Okay. The transactions then netted out within the same year, you cannot go back. You cannot go back for the gains. So basically, if you realize gain in the current year, you could use losses from the prior year, but if you realize losses in the current year, you cannot carry losses back. So, and that's what, as we dubbed him, a stubborn taxpayer tried to argue in the tax court that he can carry those losses from the sale of the crypto back to offset his gains. And unfortunately, the rules currently such that you cannot do so. And it went all the way to tax court, and it was, of course, shut down there. But you can hear more about this case if you listen to the podcast. So therefore, I think maybe the main takeaway from this one is that when the year comes to an end, when the year comes to close, And even as you sell, let's say Bitcoin went up and you wanted to invest it for Ethereum and realize, and as such, you would realize a huge gain. I would strongly recommend you converting, I don't know, 10, 20, 30% to some sort to US dollars. I mean, if we're talking about US taxation, yes, that would be the least risky US dollars, just in case. What if then crypto goes down by the end of the year or by the time when you want to pay your taxes? Then you can get into this very unpleasant situation with a lot of gain and no money to pay the tax. So that would be not a well planned idea. And to provide us a little bit of insurance again, so I think it's wise to convert some of it to fiat or US dollars and put it on the pay estimated tax perhaps with that, or even put it on a money market account. It's even works that way. So in another points covered in the podcast, of course, everybody knows this year we have 1099K form that everybody is getting right now that covers payment processing services that process crypto transactions for $5,000 or more this year. So anybody who got crypto payments $5,000 or more through a payment processing service will get that form. Starting in 2025 for this current year, brokers will have to report transactions on Form 1099-DA. That's you will see it in 2026. Not this January, but next January, they'll start reporting. So beyond basics, for 2025, something to look forward to. IRS has issued new rules. I think it was procedures, right? Under revenue procedures, right? How we should calculate basis for crypto. It was a big surprise how they're doing it, and we're going to cover it on future podcasts, maybe within a week or two. So stay tuned. You'll be super surprised if you haven't heard of these rules, but it's quite different. Okay, so if we can go to ESOP slide now. Now next, our next podcast is employee stock ownership plans. I think it's an absolutely fascinating area that has been gaining momentum recently. At least a few people I know somehow either running funds or actively advising in this area. I don't know if you people are here today or not, but if you're here, it would be great. If not, we'll catch up with you later. So it's fascinating. Why? Shareholders can sell the stock to this ESOP while the corporation takes a pension deduction from its income. So you run a business, you take a pension deduction, the money goes into this pension plan, then you pay from that pension. Of course, it's once ESOP decides to buy employer stock, it does, but effectively they're buying from you as a shareholder. And there is this amazing section 1042 that allows you to defer the gain on the sale of this if you reinvest the money within 1 year. So you're given 12 months to think what you're going to do with this money. There's another rollover if you sell to someone else. If you sell to someone else, you have to do it within 60 days. Okay. But here, when you sell to ESOP, you get 12 months. And the assets in which you can reinvest are broader. So you can do a lot of interesting things. So you can listen to that podcast for more information. But I think it's an amazing tool, especially if you run a business or you know someone who runs a business and they would like to incentivize their employees with ownership, So and especially now in the current economy when US is trying to rebuild a little bit how it's doing business, I think this tool will be very, very on demand. So I would say we should look for it. And if anyone who's listening now or later, if you would like us to cover some areas of these rules more in depth, happy to do so. The court case that we present in the current podcast has to do with a situation where a former shareholder, the person who sold to ESOP, wanted to, they rolled over. They rolled over to 1042. They used 1042 to roll over, but then they borrowed something against that asset. And it so happened that they shouldn't have done it because it kind of blew this transaction. And the gain became taxable because there are certain limitations and things about it. Therefore, it's an amazing area, great opportunity, but one must be very careful how things are done. So there you go, employee stock ownership plan. Highly recommend to look into it and for yourself or your friends. Next up, episode number 3. It's digital sales transactions. As we all could observe for the past 30 years or so, the world has become more digital and more international. Now, digital assets and AI didn't leave the IRS another choice, but to issue the final regulations, finally, on how it would like to treat digital assets and cloud transactions. So they had it out as proposed regulations for quite a while, but we weren't sure exactly what would be final. And plus, if it's in proposed stage, you cannot rely on this yet, on those rules. That's why I felt like we were a little bit in limbo. We kind of think that's going to be, but it's not yet. But finally, in January this year, January 14th, I think, or 15th, they published it, finalized it. And now we have the rules, new rules. So these regulations mostly apply in an international context. I believe they should be considered by the CFOs and the finance team of the global entities, because it's taxation and how products are packaged and where the sale occurs from. For example, if it's a foreign company sells towards the United States, or is it from US, sells to foreign jurisdictions, in order there's tax applied in the US or in foreign jurisdictions, it will affect whether or not you can claim foreign tax credits or if you have to pay tax in the US. Okay, so it's kind of, I think it's a very important piece of rulings, and we're still looking at it and studying because they have 22 examples or even more actual examples in our, we're kind of digging into it right now. But the podcast already has a lot of valuable information. And to think about those rules, I came up with this mnemonic, cloud risk. So basically, IRS took this whole area of digital sales and it says, okay, let's have cloud transactions. That's what the cloud is, cloud transactions, or SaaS is the same as SaaS basically. Then we have rights. Then we have copyrighted article sales. Then we have sales of services. And then we have sales of know-how. So easy to remember, it's cloud risk. And then I looked up on ChatGPT and it told me that cloud risk is actually a thing from social media. It's some sort of risk of doing something incorrect that's something to do with the government or regulatory, almost fitting very perfectly to our topic. Anyway, so now all the digital sales could fall in one of those categories, in one of those cloud risk category. But then characterization depends on the predominant use of the product. So you can have complex product that can have some of those elements present, but ultimately they say we're going to view this product based on the predominant element in how people use it. So this is very important. Predominant use. It's a new concept. We'll go through an example very soon. But then once you determine predominant use, once you understand what type of transaction this is, then you can determine where the source of income, where is the source of income. Okay, so what interesting is that the copyrighted article sales now is pretty clearly depend on the billing address of the buyer. So you go to Stripe, to Apple or Google, and you have billing address. So wherever billing address is, that's where your transaction is going to be sourced to, black and white from now on. And then they say, but if it's abusive, if you just somehow put fake billing addresses or something like, I don't know what they're trying to say to tell us how abusive can it be. But if it's somewhat abusive, then IRS has the right to look into it and recharacterize it. But default billing address, and for 99.9% of us, that's how it's going to be. But let's say if it's a cloud transaction, if it's software as a service, then it's services, considered services. And therefore, I guess, that's my conclusion, the source of transactions where the servers are. Or I guess that's because the SaaS, software as a service, is provided where the servers actually physically located. Then, of course, there could be a number of terrible issues. If you use Amazon, you don't know where the servers are, or but they change, and that's a separate matter. Will have to be dealt with later on application, but for now, that's the rules. So as I said, there are a lot of examples. We're still thinking about them. Here's the simple one. For example, imagine there is a movies and TV shows, streaming, renting, and purchasing. So you can stream, you can then rent from them, and you can purchase. Easy. So renting, classified as a lease of a copyrighted article, because access is temporary and similar to returning a physical copy, so it's lease, naturally. Purchasing is a sale. So when you simply download it, you can keep a copy. Then it's a sale of copyrighted article, and again, sourcing. And streaming, it's they distinguish streaming. They say it's not digital content transaction. That's the cloud transaction, and therefore it's software as a service. So in this case, streaming would be software as a service, and it will be a service, treated as a service. So now, one of the examples, if company, and here's an example for predominant use, okay? For example, company charges you for a streaming content. Let's say you're watching movies, it's all streaming mostly, but sometimes you can download a movie. For example, if you know you're going to be offline, they allow you to download. It's saved on your computer, and then somehow it's deleted, or you delete it later. Because the predominant use of how you're using the services is streaming, all of it will be considered as a streaming. So it's not going to be considered a sale of copyrighted article. Yeah, I think it's fascinating. If you guys want to know more about it, or more about specific aspects of these rules, happy to put into the materials and make a presentation. As you know, those are 10 to 20 minutes. We cannot fit all the rules into it, but happy to listen to questions and respond to interest. Okay, that's it for this one, digital content transfers and copyrighted. So next we'll go to credits. So what's amazing is that this year, 2025, is 50 years since earned income credit was introduced. I have to say, in my early years in the United States, I loved this thing when I could just claim the earned income credit. It was such a good tax time. So I was looking forward to my tax time in that regard. But 50 years, so we decided to run a short podcast for credits that taxpayers can get. So we can have a child credit, $2,000 or $500, depending on whether or not you have Social Security or you have IT and then where you lived. I mean, not you, but children, right? So your dependent children, in order to get full $2,000 credit, you have to have Social Security. And if you want a $500 credit, you at least need to have an IT by the time when you submit tax return. Okay, so that's very important. And of course, regarding earned income credit, um, it can vary depending on the size. Of course, it can get some $1,800 per family. And we have a court case there regarding earned income credit, a situation where grandmother wanted to claim it for her grandson, but grandchild, and she couldn't do it because he didn't live with her or she didn't live with her for at least half a year. So there's one of the requirements: the child needs to be with you. So, and if child didn't live, therefore you're not entitled to that credit, even though you can claim the person as a dependent under some other rules or some other variations, but not to claim the credit. So, and it's it's a reminder for us to structure things properly. And of course, who can claim earned income credits nowadays? Probably grandmother is the best person to do that. Anyways, so the credit card, so it's a powerful tool. We should pay attention to it. 50 years, hooray, celebrate it. Okay, and the last one for me to quickly present. I know I'm a little above, over and above my time. It's a home office deduction. It's amazing. In how many? Maybe about like 10 years ago or so, I did an in-depth study, and if anybody is interested in reading my article, it's about 20-page article, in-depth study on home office deduction, how it's done, who can do it, what the rules are, and so on and so forth. And I was amazed back then that every year somebody ends up in tax court, argues all the points that have been argued before, time and again, in different variation, and again, either win or lose, win or lose. And it's amazing how you can never tell if they're going to prevail or going to lose. So the only thing that I had to take away, that if somehow you don't claim more than 25% of your home as a home office, for the most part, it doesn't end up in the court. So basically, my big takeaway was, okay, just don't claim too much. Just claim no more than 25%. It should be fine. Statistically speaking, I'll look maybe at about 50 plus cases, if not more. And statistically speaking, I've never seen any smaller claims. It's always seemed to be like big areas. And so we have an amazing case that we will cover in this particular podcast. Oh, but before the case, let me tell you the basic rules. So you have to use your part of your home as a principal place of business for your business on exclusive and regular basis. Exclusive means that you cannot, I don't know, eat there, watch movies, maybe have parties with someone other than maybe business associates. And those should be business parties, not just any kind of party. And so it's pretty it's pretty specific, but nobody knows what we're doing in our homes, so it's kind of easy to say I use it exclusively, and probably nobody would ever know, as long as you have a good area, normal area with a table and maybe a computer, a printer, or some other office things. So it's not very difficult to claim. And auditors, I know we've seen auditor objecting to reasonable area of the home or to reasonably looking office. Even if they might come 3 years after the fact, after the year of the use. But here, the taxpayer, in calculating the area, they simply added up the rooms. They didn't go with the actual footage of the place. They just decided, we have 5 rooms, and we're going to show 2 rooms as a business area. In reality, the area was 25%, but if you calculate 2 out of 5, it makes it 40%. So they claim 40%. It's no, can't do that. And it's amazing that things like that end up in tax court. So it's a case of another stubborn taxpayer. So there you go. Don't be stubborn, but good planning, arrangement, and not being too greedy, I think will go a long way in the home office real. All right. That was it. Thank you so much. Rox?
All right, thank you, Dmitry. I think that was very enriching. And as you said, I think we're going to need to unpack some of these rules maybe in a different format because it's very detailed. But I think for what we've covered today, I hope our viewers have gotten some great value. But I appreciate your time, Dmitry. And as we've mentioned, please visit our channel on Spotify as well as YouTube. Look for iFindTaxPro Tax Talk, and you'll get some more in-depth breakdown of each one of these episodes that Dmitry's covered. And if you have any more questions, do reach out to us. And also leave your comments in the chat if you have any questions that you'd like Dmitry to cover, or if you have any comments or suggestions, we are always open. So thank you, Dmitry, for joining us. And we're going to invite our next guest, Stan.
Thank you, Rox. Thank you, Dmitry. It's very interesting how much you can claim out of your home. I think it's very important, I think, for a lot of entrepreneurs.
Especially since COVID. Yes.
So, since COVID, it's a big thing. Yeah.
Right. So Stan, the floor is yours, and we'll look forward to your session. Thank you for joining us.
So I will speak how to make money and not run out of the money that you then can file taxes with Dmitry, and you will have substance on your income position, and how to manage all of this. So just a few things why you should listen to me. I've been working more than 18 years with entrepreneurs, business owners from different kind of size. I used to work in corporate lending, investment banking, now running my own fractional CFO consulting company. And I've just seen different stories, completely different. I've seen very successful businesses that turns into the bankruptcy in a few quarters. I've seen businesses with over leverage that survive and doing business even with very high leverage, years and years. And I've seen stories when great businesses just turn almost into restructuring, just in a few quarters. And I kind of see the facts that contribute to the successful business that survive and prospering, and those that kind of end up in either just shut down or completely in disarray. And I kind of share those main 3 lessons that I learned and what I see, and what founders, what they're doing wrong, and when they kind of mistreat the what's happening in the business and make wrong decisions. So the first one is just it probably sounds obvious, but it's what I see again and again, especially for emerging business owners and entrepreneurs, when you don't have enough paying customers, and especially it's when you when you're alone, I know you have one contractor, it's kind of like it's hard to run out of the money, like out of cash flow, if you don't have enough customers, but you don't have enough like expenses, and you can manage this and you can measure it. But like, what happens, like when the product or service that you're providing is not really strong, you don't really find the right food with this product, and you don't charge enough, but you see there's like, I know, number of customers that using it, but like margin is not really good, but you see like you have more customers and you need to scale, like your overheads is growing. And what's happening, you kind of like you kind of have a revenue, you kind of have expenses, but like because you don't really find this product market fit, it's either the product or service is not good, or like pricing is not good, or you just like you haven't yet found your ideal customer. Like you kind of balancing on this kind of like in between, right? It's not that you kind of like don't really have any money, but it's also you don't make any kind of additional money. And especially if you end up like your time and your effort, and you're probably working, I know, at least like 9 hours a day, like your time, it's going to be definitely loss-making business, right? After you like just factoring the cost of the time and effort of the business owners. Yeah, and like usually product market fit it's about like startups. I see it's also about a business, like just like not innovative, just normal businesses where you don't really find these kind of like right relationships between your product and service and your customers, and how much you should charge, and like do they receive this value. It's kind of like this triangle between like those factors. So make sure, because like especially if it's not a startup, if you are not really want to sponsoring like your early revenue growth, like margin should be good in the very beginning. And especially even if it's something new, it's like it's kind of like your early customers, your early adopters, they willingness actually to pay higher, trying something new. It's like you should have these margins, right? Like I'm talking about gross margins, right? Like your revenue minus what is the direct cost associated to provide your service and your products, right? Like it's like you should really like kind of like see this. And and then I see like another thing, it's like continuously tweaking the product or service. You're thinking like you add some feature, or then you can charge more, or like but it's like sometimes it's just you don't charge enough, and it's probably why you don't charge enough, because you just haven't yet found your ideal customers. I remember when I was starting, just from my personal experience, I started doing this kind of like a financial consulting. At that time, it didn't call a fractional CFO. And I remember I started working with startups mostly. And like, I know I charged them, I don't know, like 2,000 a month, or like, I don't know, 1,500 a month. And like, I know like they hardly can pay it, and and they like asking like so many things that I should have done for them for this price, and it just wasn't like, and it wasn't sustainable business model. And at one point I even thought like, okay, it's just not really profitable business. But like what I didn't figure out at that time, it just was the wrong clients. It's just like I need to go upstream. So when I start working with the clients that at least like 2-3 million of revenue, okay, it's like it's a completely game changer. So I charge the price that really makes sense for me. I keep my gross margin, and it's just everything is just put in place, and everything you see, okay, it's in the right place, and then I can scale it. If I would start scaling like this my early price, it would be a disaster, because I couldn't find a good people to provide this service, and like my margins would be like, I don't know, 10%, 20% after all. And it's just like it would be scalable. I could scale it, like I on paper I could get more clients, but my financial results is going to be a disaster, right? Like it's hardly be break even, and I will work more and more hours because this more clients, more attention, like more employees or contractors and so on. So I think it's super important to find kind of like your product market fit before you start scaling. And scaling, I mean, it's like investing more in marketing, get more clients, hire more people, like whatever definitions for you of scaling. It's how you can avoid this kind of customer curve. Just grow slowly. Yeah, I think it's even like for startups, it's kind of like, I know like growth is everything now, like because of this kind of like VC money now is harder to get, and now people more thinking about like gross margins and profitability and so on. So probably now it's more about profit than it was like 2 years ago, 3 years ago. And just confirm that you have a real paying customers, confirm that you're delivering value, and confirm that the price they pay is enough for you, not even cover like existing costs, but how you will grow the company. Like what else do you need? Like, okay, it's probably when it's going to be 10 customers, you need an account manager, or you need somebody else that just sustain these things. You like probably right now you're doing some of these things, and you just like at some point you need to step down from those roles. Just put it also in your economics and see what's happening. So grow slowly, make sure that you stick to the right gross margin, and then you can scale your product. Yeah, just like those signs of product market fit, it's like it's more from the startup world, but I think it's also apply to the just business owners, just the normal businesses, not only innovative ones. So it's high organic growth, word of mouth referrals, waiting list, or like high demand, low churn, repeat usage, right, and high scoring and net promote score, just like high loyalty from your customers. And as a result of this, you will have consistent and predictable revenue, right? So it's kind of like as you find this product market fit, your financials kind of like will automatically be in place, right? Because your gross margin is gonna be good, your revenue is gonna be consistent, and it's gonna be good, and it's probably your business will grow because you will start getting those referrals, you will start getting like just like word of mouth spreading, right? And customer lifetime value, like how long one customer's working with you and how much in terms of revenue you get for them. Second, so it was the first reasons why business is actually falling, and the second largest reason that I see, it's like I call it lack of financial clarity, just like lack of any financial foundation when you start your business. So I know how it's happening. Like when you start the business, especially like first time founders, they don't really think about accounting, or they don't think about like set up like, I know, like a software, like really looking for the numbers. They're doing this mental model policy, what I'm calling, when like, okay, I receive like this advance from one customer, and I receive like this payment from another customer, and I need to pay Joe like for this work, and I need to pay like those, I know, fixed payments, right? Like this, and here's my profit. But this mental model policy, it's kind of, it works in the very, very beginning when you have like 1-2 clients, you don't have like more than 5 expenses every month. It works. Like I'm not arguing against this, but as you increase compliance, as you got like, I know, 200K, as you get like, I know, 5 clients, it starts messy. Even if you're working in a really simple business, like I know, as a consulting, like you start getting like these advance payments, and then you're getting like you need like to pay like your staff or your contractors, and then start messy. Like you will definitely not keep up with all your payments in your head. And like I see like the biggest difference between first time founder and second time founder. It's just like they second time founder, they start business, all of them. I literally, it's just, I see it all the time. They start business with like first day of the new business. They just starting like an accounting. They like find someone who will run from the first day, because they already experience this. When it's become messy, it will take so much time, go like through, I know, back like even like 9 months ago, and trying to figure out, oh, I paid this for what, like what was this payment, like, oh, like why I received this, what is it was advancement payment, or it was like a pay, or it was like for this contract or that contract. It's just like you will spend so much more time just trying to figure out, and sometimes people just cannot figure out, like, right, like Dmitry mentioned, like a crypto, and like if you somehow in the crypto sector, like it just like there's no description in your payments, right? Like literally people cannot remember why they send this, and they cannot see who they send this payment for, right? It's just like they just you can just reconcile this. So it's super important to start your first day with accounting. You can run it by yourself if there's not enough means, and yeah, but it's just like it's a foundation. And the second thing, like you can't really make any serious financial decisions without financial data. Like it's just like, I don't know, like you think like, okay, probably like, you know, there's some strategies that really involve financials, like, I don't know, IKEA, like from the very beginning starts like say, okay, we'll keep gross margin quite low, we will have some loss making items, but overall because of the revenue, like we'll make enough money, right? You can execute this strategy if you don't follow your gross margins. Like IKEA wouldn't exist if the owner like didn't know his gross margins across all his products, right? And I think even if you're not executing like really kind of like financial strategy is a core of your business strategy, it's still super important, like to managing, okay, what is your gross margin, what is your operating margin, where you want to be like in 1 year, in 2 years, like what do you want to achieve? Like you offering a new product, it's like it's cheaper, but you think you will get more revenue. Like you can make these decisions if you don't know like your current gross margins and what's going to be gross margins on those products. And again, back, like you can calculate gross margins if you don't have accounting set up in place in the first place. You can make these numbers. It's impossible. Yeah, it's like it's super important. I know it sounds boring. I know like a lot of business mind people, entrepreneur mind people, like they don't really want to spend even 5 minutes on accounting. If you this kind of person, I completely understand. Just hire someone and review regularly on monthly basis, like every second week, what they allocate, what's happening in your QuickBooks or Xero or other accounting software. Just look for this. Yeah, I would say like my kind of base advice. It also depends on the business. I think, like for example, if you're in a construction business, you like, I know, a contractor for like a construction site, I think it's very important to start tracking everything just from the very beginning. If you like, there like simpler businesses, I don't know, like consulting one of them, I don't know, like probably a coffee shop is going to be another one. Ways like you can do it by yourself, or you just like just wait until you reach a certain point. I think like after you cross like 100 or 150K of annual revenue, like you can hire like an accountant, and it's going to be probably 300, 400, 500 a month, or even like cheaper, depends on like how many transactions you have. And then after like, I know, 200, 300K of annual revenue, you definitely need an accountant. It's like there's no, like you should have it in place. Yeah, and if there's a rapid growth, and for example today you had 15K last month, and you like probably see it's gonna be like, I know, 40K like this month or next month, you definitely just hire an accountant right now. It's just yeah, there's no excuse. And there's a kind of like a rule of thumb that your accounting, tax, and kind of like financial function in your company shouldn't be higher than 5-6% of your annual revenue, like up to 7%. But keep in mind, if your revenue is growing, and right now it's kind of, I don't know, like 200K, but you're growing and it's going to be in 6 months, I don't know, 600K. So take 600K, because like as you will hire, as you will kind of progress, it's going to be end up in this kind of like rule of thumb. Yeah, so what is essential financial knowledge? Just like quickly overview. So like revenue, it's just like how much you're making from sales and services. It's kind of sounds obvious, but like I see even like some entrepreneurs makes mistake here and like don't really understand, because like, for example, like you receive an advancement for some future work that you should provide to your client. it's not your revenue yet. So you don't deliver service or product you promised. So it's not your revenue. It's just like a kind of an advanced financing. And for the balance sheet purpose and P&L purposes, it's not recognized as a revenue. So, and I see like a kind of founders make this mistake all the time. So direct cost, it's like direct cost is super important. It's like what's directly tied to producing and delivering your products and services, whatever it involves, right? Like for SaaS businesses, it can be cloud cost and service cost and like customer cost, right? Like for the e-commerce, it's definitely going to be the cost of goods sold of the inventory that they're selling and delivery of those inventory. So it's very important, like what's really tied to your business, and you keep track of this. And especially like I know if you have like many products, many services, different revenues, set them apart, track it separately, that you can understand like what's each part of the business generated. Yeah, overhead is just like what is not really tied to your revenue. Like if you have like, I don't know, 500K revenue and it's going to be 700 revenue, and those costs like stay the same. So it's usually kind of employees, like just like general employees. I don't know, an accounting service is going to be another overhead, like some utilities and like I know office rent, like all those costs is overhead. And I think another really important important kind of part of the essential financial knowledge is your suppliers, vendors relationships, and what's happening in terms of like your financing, like do you receive a discounts, do you pay afterwards when they provide their service or products, or you pay upfront? Like how do you manage this cycle? It's really important to track this and keep it in mind, right? Even if you do like a very early this mental model, just remember that it really affects your cash flow first of all. It's like how you manage those relationships. It will like I've seen it all. Like it's just like you can be like your revenue can be growing even like on your P&L, like net profit, gross profit, operating profit, all those metrics can be super like high, but you can be like no cash on your bank account. If you have like a very positive working capital requirements in your business, for example, e-commerce is a really good example of this. As the revenue of e-commerce is growing, you need more capital in the business, not less, like because you need more inventory. And it's just like in absolute terms you need more capital inside your business, right? Because like the cycle for the e-commerce is usually very positive. You need a lot of inventory to sell, and as you revenue grow, you need more inventory, not less, and it means more capital, not less. So it's important that you kind of understand, at least in your head, like understand like those relationships and understand your relations with the clients. Like if they don't pay immediately after you provide all your services or products, just like okay, when they pay. And I also it's bizarre. I've seen like almost every day I see it's like across all my clients when just somebody sends like invoices and they just don't really follow up, and they like stay there for their unpaid like for months, and it's happening like for small businesses, large businesses, and it's bizarre. And it's just like this is the only one thing that like it will take you only 5 minutes. Just remind your clients just to pay it. And that's it. It just like, and it will make a huge difference on your cash flow, especially if you have like a lot of those dues from clients. Yeah, and the last thing, the third reason why businesses is falling is like excessive leverage. Just like especially in like I see like two scenarios. The one is like when it's like falling really badly, it's kind of like everything is positive, revenue is growing. Usually it's also coincide with the really good macroeconomic factors, and like I don't know, you're doing like I don't know, like doors for multi offices, multifamily complexes, and they booming, they growing, and then there's like I don't know, like a recession, and market is just like there's no need for like so many houses, and your business just falling. And when you in a really like this growing phase and you think everything is positive, like humans being really kind of like they think it's going to be forever. and they like, oh, like I'm making these margins and I'm making this absolute number. I want to extend. I want like to get to new markets, or like I want to expand my team. And they take more and more leverage. And at the time, what I see, like why it's so especially dangerous, like the leverage they take is okay. So they take, I don't know, 4 EBITDA, 5 EBITDA, like and usually low interest rate. And it's kind of like on paper, this business can serve, and even some safety of margins, serve this debt and repays over time. But then when you face like this kind of like a downturn on the market, like there's two things happening. Your revenue is falling, but your margins is falling. So it's kind of like a double. So it's just like pushing you, like your revenue is falling and margins is falling, and your EBITDA usually it's not like, oh, your revenue like half what it used to be last year, and your EBITDA is half of what it used to be. No, your EBITDA is gonna be 1/4 of what used to be last year. It's like this rule works like across all industries. I've seen it all. Like it's what's happening, and then you cannot serve this debt, even like paying like interest, and then if there's some principal repayment, you just can't serve it, and it's all falling apart. Yeah, so it's kind of like be very cautious with leverage. They don't take too much, especially if it's like super positive in terms of macroeconomics, and just like be very mindful of the debt, and play scenarios. I would say like play different scenarios. As let's say, I don't know, you lose like your two biggest customers. What's gonna be with your financials? Can you still serve this debt? Like what's gonna happen? Yeah, so like I'm not against that, but you should be very cautious, because I think it's the biggest reasons when you over like, I don't know, 1 million, 3 million, 5 million revenue. It's the big, like other things not really killing your business. Like you can survive like losing your customers, like I don't know, market shift. You can pivot. You can survive. I've seen it all, but like the leverage can kill you. Yeah, and yeah, super important to keep it low and very mindful, and don't take any debt until you not sort out your financials, until you don't know like your margins, you don't know, like you don't have a proper balance sheet. Like don't take any debt. It's just like it's a nightmare. Yeah, as I said, like yeah, how to prepare for economic changes, just run scenarios, manage debt wisely, and yeah, just what yeah and another what I see, like I don't know, there's some changes in the market, or like in your product, or you're losing your competition to competitors, and it's just people think, oh, and they start running out of the money, right? Like there's not enough money, they probably don't have enough like to just buy new inventory, and they think like, oh, I just need that, I just need one more like 500,000, I will solve all my issues, I will buy inventory. And so they just don't working with the cause of the issues, right? Why they end up with less money and they need, but they think, oh, just like the money is the problem. It's not the money. It's like usually it's not the money. Like if everything is okay, you won't think about money, because if you find the product market fit, you know your margins, you grow kind of like really mindful, like you won't think about money, because there's going to be enough money on your bank account. When you like grow very aggressively, or there's a certain things that you're not really sorted out, then it's issue of the money, or there's something's changed, and then you take debt, you just amplify all the issues you have, because you have more debt, you need to pay more money to serve your debt, not less, and you haven't solved your core issues. Yeah, so yeah, just like summarize, focus on your real customer demand. It's super important. It's just like find your customers, make sure that gross margin is okay, make sure that they pay enough to sustain your business, understand your financial picture, and constantly looking for this, update this, working with your accountant, and yeah, and manage that responsibly, and then you can build what I say like is unfollowable business. Yep. Thank you very much. Really appreciate it. Yeah, happy to answer any questions.
Well, thank you, Stan. That was a really engaging conversation. And I think I wanted to ask some questions myself. I think you mentioned that over 90% of businesses fail. What is the single biggest mistake you've seen entrepreneurs make? And how do you think they can avoid it?
Yeah, it's what I say, like just like the biggest mistake is just don't have enough customers that paying enough to sustain the business model. It's like not really finding the product market fit and start scaling. It's like it's the biggest issue. Like especially in very early.
But then, that comes into question that, and if it's a startup developing new product or new service or looking for new customers, then I guess it would be having enough money to have time, right? To buy enough time to do all this, right? That would be because have you seen any interesting situations when in other months and it would be great and they couldn't make it, somebody bought it for almost nothing and they made it because the product was great.
Yeah, I've seen different scenarios, but I think like the product market fit is from startup world, right? And but I just see that it's totally applied for normal businesses as well, because it's what I see. Like I know you start doing something, I don't know, for example, you knew, I don't know, to gardening and you want to get some revenue. I think, okay, how I get like first customers? Oh, I will offer like half the price of my competitor and I will get new customers, right? And yeah, and then they start kind of like scaling it, but like keeping the same price, but it's not sustainable, right? And like they don't really find their real customers, and they start to scaling. It's just like it's all falling apart. Regarding the startups, it's still kind of like the same things. It's like I've seen it so many times when startups just like this matter grow at like whatever it takes, right? Like just grow. But you see like when they don't have a product market fit, then there's not really like they don't really find these ideal customers, ideal pricing, ideal value propositions for their product, and they start growing. They have customers, but margins is super low. And what is happening is usually on the marketing side, they need to spend so much money on marketing to acquire customers because this product market fit is not in the place, and they kind of like start running out the money. But they think everything is okay. We have customers, right? They even pay something, right? They think everything is okay. We just need more marketing money. And we've seen these stories. They even like go from one round to another. Like revenue is probably growing, but margins is horrible. Like they spend too much time, too much money on marketing, on customer acquisition costs, and it just end up in disaster. Yeah, and I've seen these stories about startups. Like I don't know, like I just heard like recently one, like they have one large customer. It was like an AI startup, and they just lost it, and they just cannot sustain it. It's just like they closing. Yeah.
Right.
Concentration of risk. And many businesses think more funding equals more success, right? Well, how would you advise startups specifically who are considering raising external capital? Because there's that fallacy that more funding equals more success.
Yeah, I would definitely. I think right now there's a new trend, kind of like get only one funding, because now it's kind of get some tractions. Or like I would say, like especially right now with AI, it's kind of like it's so easy to keep company leans, right? Like we're looking at these AI companies, so like they have like 15, 20 employees, right? Like it's you don't really need a lot of money just to start and testing. Like I would say grow at all costs when you get this product market fit. It's kind of like, and usually VC is also looking for this product market fit. They want to see like what's customers paying for. Is it a healthy price, and what's they get, right? So like for this price.
Amazing. Yeah. To that point, more money, more funding means success. I don't know, Stan or Alex, did you guys?
I have one just short story.
Yeah.
Like I was like completely surprised because of this abundance of VC funding for the last like 3-4 years. Like it's this idea so embedded in the minds of everyone that like if you start your business, you need to like investor first. It's so wrong. I spoke once with one guy, he was like IT implementer, like implementing NetSuite. And if you know like this business, it's like it's a really good margins. Like it's like you don't need any money. You just find one investor, you get your project done, you have enough margins. It's like there's more margins than for my fractional CFO business. And this guy was looking for investors, and I told him like, why you need like an investor? It's just like it doesn't make any sense. Oh, like I need like this employee, but I said like you can find a contractor. You can start with contractor and just like find a client, find second client. When you have enough workflow, hire this contractor, find another contract. It's so easy. And this idea that I need money, it's just like it's so wrong. Like you need money when all other components in place, and then you need money.
Yeah, I agree with you, right? So you got to be nimble, right? That's in the beginning, you're nimble, you try to understand exactly who needs your service and why and how to sell it, and find a new, like anybody who pays $1 and then build from there. But of course, don't scale it unless they pay enough. Yeah, Rax, what did you want to say?
Yeah, I see the theme of product market fit being key, and Stan, you highlight the importance of real paying customers. What are the signs though that a business actually has product market fit?
Yeah, it's what I mentioned in my presentation. It's like it's usually really a high organic growth, or like some growth, like organic. It's like not you paying customers; they just find you, or like word of mouth referrals. It's also like if you have like 1-2 customers and they're referring to another one, is like it's kind of like a really strong
brand evangelist.
Yeah, like
brand evangelist.
Yeah, when you have like a low churn and like repeat usage, like it depends on the product. If it's like one time or like it's like a repeat user, it's also kind of like a really strong signals. It's just like I think like just love of your products. I think it's like strong. And when you don't really like, people think like it's also another kind of like policy, like just completely illogical. Like people think in the very beginning their customer acquisition cost is very high and then it's going to build over. It's actually inverse. It's like very early you will acquire your customers very cheap because you acquire early adopters, you acquire like those people, and then as you grow, as you get like tap into this mass market, it's gonna be harder to get like those customers and customer acquisition. I see it's just like it's the number one. I don't know. It's like it's like and I see like some business owners think, oh, like I'm testing different channels. We will optimize marketing, and it's gonna be cheaper. No, it's not gonna be cheaper. Especially like as you grow, like you tap the market, and then like every new customers is gonna be marginally. It's gonna be way more difficult to acquire them, right?
Well, unless you become very famous, right? Like, for example, in our industry, QuickBooks, they don't have to worry about customers anymore. It's kind of an oscillating curve. So at first it's low, then it's high, then it's low again, and then they pay you. You don't pay them.
Yeah, no, it's a different. I mean, when you
of course.
A staple name, like I bet Airbnb also like right now they don't spend so much money on marketing as they used to be, and the customer acquisition cost is lower than it was like 10 years ago.
Right,
exactly.
But that's what great product does, right? When you've built a great product that works, that people love, then they sell it for you. And that's the story of QuickBooks, that you'd find that it's normally tax professionals which are pushing the product for QuickBooks, pushing it to their clients. So they find they don't have to spend as much on marketing.
Yeah.
Just thinking about another example of what Stan was saying earlier and what Rax you were mentioning. More funding means more business. Okay, yeah, it may mean more business, but exactly what Stan was saying, if you're not nimble, if your cost of goods are higher than your realized income, it's definitely unsustainable, and you have to have a strategy to make it right. And I think, again, in our profession, Stan, I don't know if you followed or not, this bench.com.
I know.
It's such a famous and enormous example of because I think it was part of their model, if I'm not mistaken. I don't know exactly how they're, but I assume they would hire a bunch of accountants, do the work for them. And I guess somehow the way that they structured relationship with them wasn't the right way. They were too expensive, or they spent too much on marketing. I don't know if you know the full story why they failed, but I would imagine part of it has to do with professionals be too expensive for what they pay, or wouldn't want to stay for too long, be too organized, and eventually, once the funding money ran out, there was nothing to cover for it.
Yeah, it seems like for me, it's like there's only one reasons why it's happened. It's just like the gross margin was enough, so they kind of promote this low price for their service, and like they was betting on automation, AI, like I know early machine learning, and they couldn't deliver the cost associated to providing those services. So I bet like the gross margins wasn't enough, and as I understand, on top of that, they had like this huge overhead, like a lot of salespeople, a lot of marketing. They kind of like in this growth. So that's why I said like you can't grow if your margins is not in place. Like it just like amplify everything, and it just like amplify all the issues you have with the business. Like if your gross margin is very low and you don't have a really kind of like a really particular strategy. I know it's at IKEA, right? Like they keep margins low, but they know like they need to stick to certain revenue, and then they make like it's profitable. If you don't have this strategy in place, you just like betting that at some point you magically figure out and bring your direct cost lower, and it seems like it's never happened for a bench.
It's interesting.
And you also mentioned.
Mhm.
No, saying you also mentioned, Stan, on from a long-term success perspective, that understanding your finances and managing your debt responsibly are also key to long-term success. And what are some key habits that business owners should adopt to stay on top of this?
It's key to stay on top of the business.
To understand their finances and to manage debt responsibly. Just what are some of those key habits that business owners should adapt, right, to ensure that they're managed?
Yeah, what I mentioned is like why that is tricky, especially like as I mentioned, because I think it's really tricky. Like when you take that when everything is good and you living in a really good time. I've seen it all. Like it's just like revenue is growing, your margin is good, or it's even expanding, right? Like I don't know your gross margins, because like I know these like remember what's happening during the COVID, right? Like the margins growing, like there's not enough inventory. You charge a lot on your inventory because there's a lack of inventory. You're thinking like you're the king of the world, and people are like, oh, my margins is growing, my revenue is growing, I need more debt just to grow even faster. And on paper, like when they looking at the debt and looking at the margins, everything is okay. Like they can repay this debt with these financial terms. But what I say, like what's happening when they hit this kind of like a economic downturn, it's kind of like your revenue is contracting and then your margins is contracting. And I say like your EBITDA, if it was like 1 million, it's turned into 200K. So, and it's just like you can't even like serve your debt anymore. And I've seen this like so many times, especially like with these ebbs and flows of these like macroeconomic factors, and like like these commodity businesses, like it happens all the time. Like they get more debt, they invest more in inventory, in expanding business when times is good, and then they kind of like they face challenging times completely unprepared in terms of financial. So I say like stay humble and play scenarios. I think like what I love at play scenarios is and see, okay, what will happen if your revenue is half what you have right now? Like how it will impact your margins, what you need to do, like how many people you need to lay off to keep your margins, and can you serve this debt?
It's interesting for in my practice, obviously I'm almost 30 years already doing this, which is amazing, I think. And there are a lot of clients that we have observed that, let's say, they spend money year after year, year after year, and it's like, okay, nothing ever comes out of it. Then boom, all of a sudden, start making a lot, and it all goes well. That also, but that's of course, if you're building platform, or if you're building some specific product, or you manufacturing it, Yeah, that's of course different idea. It's not then you have to spend and you have to have enough money and you have to have enough caution, I guess, if something
Yeah.
goes wrong, to have enough time to make it right.
Yeah,
Yeah,
I
this is
think
amazing.
I think it's important not to lose your head and understand
Yeah,
that I don't know almost any business that like didn't go through the ups and downs. Like every successful business, I know Facebook, Microsoft, they had times when like their revenue is falling, like market, it seems like they're losing the market share. Like every even like super successful business going through this, and like you can imagine what's happening with the small and medium businesses. They go all through these like cycles, and you need to be prepared for this cycle. So you don't need to be over leveraged when you're going like from this up cycle to the down cycle.
right. Wow. Yeah, amazing. You
Yeah.
keep mentioning IKEA in your example. It is a perfect example. Also why I last time when many years ago I went to IKEA to buy something, and you go into this big warehouse looking thing and you pick your items, and then you go in there for delivery and scheduling assembly, right? If you ever been to IKEA. And every time when I'm standing in the delivery assembly line, I'm actually thinking about gross margins of IKEA because they make it so efficient. There's such a grand industrial scale, and that's how their margins are good, right? And you pay this $80 to do this, to do that. And I was like, okay, so that's where I remember my accounting and finance. And I say, okay, we're paying a little bit with their time, but it's kind of, they say you want stuff cheap. All right, so you'll have to work a little bit for that. And maybe that's another possible advice to people who run those things. Maybe make it a little perfect for people, a little bit perfect, so that they understand they get a bargain at a good price, but they'll have to do something themselves. Maybe it's also part of a strategy. I think
I
IKEA had
think
it
a
in
key
mind for sure.
word is I think a key word is picking the right business model. I think that's something that stands out for
Yeah,
IKEA is
you're
that
all
their business model is translatable to such a wider audience as opposed to your high-end furniture makers. And I think that's another um, challenge for startups is picking the right business model and picking the right audience, right, that you're going to service,
yeah.
the right customer.
Yeah, but I think it's just like whatever strategy you choose, just like those strategies can be executed without proper financials. So as I said, like you can't execute this strategy if you don't really follow your gross margins, right? Like Camper really knew his numbers. He knew like what's the cost
Right.
of his like pencils that he was starting selling when he was like, I know, 18 years old, and what's the selling price and how much he should make, and so he was really deliberate about this.
Mm-hmm.
Yeah. Yeah. Wonderful.
Amazing.
Wonderful.
Yeah.
Yeah.
What
Well,
do you? Yeah, I'm just yeah. So we'll finish in a moment, but I think for some of the next seminars that we're thinking of having, we would like to invite some people from financing realm that provide the money that's necessary for various things. What do you see? I don't know, either among your clients or among statistics that you follow, how much of what companies get as debt financing and how much of it is equity financing now? How would you rank the current environment? Is
Uh,
it
I,
more of that now? Less? Uh-huh.
I think it
Yeah.
depends. Depends on the sector. Like startups, startups still growing through the equity very early, like seed, pre-seed, round A. Like I see, like in round B, especially right now, you have less investors in round B, and they more kind of like deliberate in terms of like their choices and just I see like especially at round B, it should be already kind of like cash flow kind of positive or close to the break even. I see like more companies use debt solutions or like debt convertible solutions, kind of like a yeah mixed solutions.
Okay, interesting. Yeah, I understand. Of course, if you have a solid product to sell that you can factor, I mean, do the factoring. I mean, for it's probably that is preferable. But if you don't have it yet, right? So that's probably equity. Uh, yeah, but I was curious because usually in my understanding, it's for that it's very hard to realize. We have to have some kind of a existing something very important so that somebody can ledge it.
Yeah.
Anyway, so that's good.
Yeah.
Okay, I'm good. Rocks.
Yeah. So, gentlemen, I think that was a rich discussion. Maybe before we wrap up, where can people contact you? Stan, your details are up. Maybe you can just close and let our viewers know where they can reach out to you.
Yeah, just like follow me on LinkedIn, Stan Sukhin, and Stan 3S on X or Twitter. Yeah, just I write daily on LinkedIn and Twitter. So
wonderful, wonderful. Thank you
yeah.
for being with us, Stan. And Dmitry, can you tell us a bit more about where people can reach Kustov CPA?
Of course, I think the same thing. You bring me up. Okay, yeah. LinkedIn. It's my LinkedIn, right? Yeah, perfect. Email, LinkedIn, and our website are perfect places. Everybody is welcome. And if you have any questions about these topics or other topics, I'll be happy to speak with you. Thank you for listening.
Wonderful. And then also please follow iFindTaxPro on all the major platforms at iFindTaxPro. And please do comment, like, and subscribe to our channel, and look out for more content that's going to be coming out. But I just want to thank you two gentlemen for being a part of this, and look forward to engaging further going forward. So enjoy your evening and your day, your afternoon, wherever you are.
Yeah. Thank you, Rox. Thank you, Dmitry. It was great.
Thank you. Thank you, Stan.
Yeah.
Thanks, gentlemen.
Yeah. Thank you. Bye-bye.